The unthinkable is about to happen to the stock market, and almost nobody is talking about it. Not the kind of unthinkable where everything crashes to zero and we're all eating canned beans in a bunker. I'm talking about something quieter than that, and honestly, something a lot more dangerous, because it's already happening right now while you're watching this video, and by the time it shows up on the nightly news, it'll be too late for most people to do anything about it. So stick with me for the next few minutes, because I'm going to walk you through exactly what's coming, why it's coming, and more importantly, what you can actually do about it before everybody else figures it out. Here's the thing nobody wants to say out loud. The stock market you think you're investing in isn't really the stock market anymore. I know that sounds crazy. You pull up your app, you see the ticker, the number's green or it's red, and it feels real. It feels like the same market your parents invested in, the same market from the movies with guys yelling on a trading floor. But that market is basically gone, and what's replaced it is thinner, faster, and way more fragile than almost anybody realizes, including a lot of people who manage money for a living. Let me back up and tell you why I even care about this stuff. Because I want you to understand where I'm coming from. I didn't grow up around money. I grew up in a house where a bounce check was a family emergency. My first real business wasn't some genius idea. It was me figuring out I could buy something cheap and sell it for a little more, and doing that over and over until it turned into something bigger. I'd built things from nothing. I've had things fall apart on me. I've made money and I've lost money, sometimes in the same week. And somewhere along the way, I fell in love with markets, not because I think they're some magical wealth machine, but because they're the closest thing we have to a live scoreboard of human decision-making, millions of people making bets on the future, all at once, all in public. That's what a market really is. And right now, that scoreboard is showing some very strange numbers. So let's talk about what's actually changed. In plain English, no jargon, I promise. 30 years ago, if you wanted to invest, you picked stocks, or your broker picked them for you, and there were thousands of individual companies to choose from on the public market, real diversity, real competition for your dollar. Today, the number of publicly traded companies in the US has been cut nearly in half since the late 1990s. Companies are staying private longer, getting bought out, merging, or just never going public in the first place because there's so much private money floating around that they don't need to. So the pie of available public stocks has gotten smaller. At the same time, more money than ever is pouring into the market because everybody with a 401 kilobits, everybody with an index fund, everybody with an app on their phone, they're all funneling their savings into the same shrinking pool of companies. You following me? Smaller pool, way more water pouring into it. That alone should make you a little nervous. But it's not even the main event. Here's the main event. Most of that money isn't being invested by people anymore. It's being invested by index funds and passive strategies that just buy the market automatically. No thinking involved. And by algorithms and trading systems that react in milliseconds to patterns in the data. I'm not knocking index funds, by the way. They're actually a great tool for most regular people. I'll get to that. But think about what it means when the majority of the dollars flowing into stocks every single day aren't being placed by someone who read the company's earnings report or toured the factory or asked a hard question on an earnings call. They're being placed automatically because a paycheck showed up and a percentage of it goes into the same handful of giant companies every 2 weeks, whether those companies are cheap, expensive, healthy, or rotting from the inside. That's not investing. That's autopilot. And autopilot works great right up until it doesn't. So here's the unthinkable part. When you have a market where a huge chunk of the money is on autopilot and where the real human price-checking investors have gotten smaller as a share of the whole thing, that market becomes what I'd call thin. It looks fine on a calm day. Actually, it looks great on a calm day because autopilot money just keeps flowing in, pushing prices up quarter after quarter, and everybody feels like a genius. But a thin market is like a thin sheet of ice. It holds your weight just fine until the one day it doesn't. And when it cracks, it doesn't crack a little. It cracks all at once because there aren't enough real buyers standing around ready to catch the fall. The automatic money that pushed prices up on the way in can pull out just as automatically on the way down, sometimes triggered by nothing more than a computer program reading a headline wrong. We've actually already seen little previews of this. You might remember days where the market dropped several percent in minutes for what looked like no real reason, and then mostly recovered by the afternoon. Those aren't random glitches. Those are little tremors. Small examples of what happens when a market has gotten thinner than people realize and a wave of automatic selling hits before human beings even have time to ask, wait, does this actually make sense? Most people shrug those days off as a blip. I think they're a preview of a coming attraction. And the coming attraction is going to be bigger, faster, and it's going to hit right when everyone least expects it, probably during some ordinary news cycle that snowballs, because the market simply doesn't have the depth to absorb it calmly anymore. Now, I want to be honest with you about something, because I think honesty is the whole point of this channel. I don't know the exact day this happens. Nobody does. And anybody who tells you they know the exact day is trying to sell you something you shouldn't buy. I'm not a psychic and I'm not your financial advisor. I'm just a guy who's spent a long time around money, who's made plenty of mistakes, and who's telling you what I see building up under the surface so you're not caught flat-footed. Think of this less like a weather forecast with an exact date and more like watching storm clouds build on the horizon. You don't know the minute it's going to pour, but you'd be a fool to leave your windows open. So what does this actually mean for you, the regular person watching this, who isn't running a hedge fund, who's just trying to retire someday without eating cat food? A few things, and I want to walk through them like I'd explain it to my own family at the dinner table, because that's really who I'm talking to. First, don't panic and don't try to be a hero. The instinct a lot of people have when they hear something like this is to pull everything out of the market and sit in cash, waiting for the crash, and then jump back in at the perfect bottom. I've watched smart people try that for decades, and I can tell you from experience, almost nobody times it right. You either get out too early and miss years of gains waiting for a crash that takes forever to show up, or you get back in too late after it's already recovered. Trying to perfectly dodge a storm you can't predict the exact timing of is how you end up worse off than if you just kept your umbrella handy and kept walking. Second, and this is the part that actually matters, understand the difference between owning good businesses and owning the market as a blind number. If the fragility I'm talking about is real, and I believe it is, then what protects you isn't guessing the date of the crack in the ice. It's making sure what you own can survive the crack when it comes. That means real businesses with real cash flow, real profits, low debt, things people actually need, whether the economy is booming or scraping by. It means not being so concentrated in the handful of massive companies that everyone's autopilot money is piling into. Because when the autopilot money reverses, those are exactly the stocks that get hit hardest, precisely because they got the most artificial support on the way up. It's the businesses everybody ignored, the boring, profitable, unloved ones that tend to hold up when the exciting, crowded stuff gets shaken out. Third, and I say this to my own kids all the time, cash isn't a dirty word. Somewhere along the way, people got convinced that keeping any money on the sidelines means you're missing out and that you have to be 100% invested at all times or you're doing it wrong. That's nonsense. And honestly, it's the kind of thing that benefits the people selling you products, not the people trying to protect your future. Having some dry powder, some money sitting ready, means that when this thin ice finally cracks and good businesses go on sale for no good reason other than a wave of automatic selling, you're one of the people who gets to buy instead of one of the people forced to sell at the worst possible moment because you needed the cash. Let me give you a real-world comparison, because numbers on a screen don't always land until you picture something you can actually touch. Think about a small-town hardware store. For years, it's the only place in town to buy a hammer. So anybody who needs one walks in, looks around, decides if the price is fair, maybe haggles a little, and buys it. That's a real market, real human beings deciding real prices based on real information. Now imagine that town changes. A machine gets installed out front that automatically buys a hammer every single Friday no matter what, because that's just what the machine is programmed to do. Rain or shine, good hammer or bad hammer, fair price or not. For a while, the store owner's thrilled. Steady demand every Friday. Prices creep up because there's a guaranteed buyer no matter what. But now ask yourself, what happens the one Friday the machine gets reprogrammed or breaks, or a bunch of machines from other stores all decide to sell their hammers back at the same time? For some reason, none of us predicted. There's no real human buyer standing there anymore to catch it, because the humans stopped showing up years ago. The machine did all the buying. That, in a nutshell, is what I mean when I say a huge amount of today's stock market isn't, of course, really being priced by people anymore. It's being priced by scheduled, automatic buying that shows up whether or not it makes any sense. And that same automation can just as easily reverse. I also want to talk for a second about something most videos like this skip completely, which is what this fragility does to good, boring companies that never get talked about. Here's the part that actually excites me, if I'm honest. When a thin market cracks, it doesn't crack because businesses suddenly become worthless. It cracks because of positioning, leverage, and panic. All things that have nothing to do with whether a company is actually healthy. So you end up in this strange situation where a company that makes real money, sells a real product, and has been quietly profitable for 20 years, gets dragged down 30% in a week, right alongside the overpriced hype stock that probably deserved to fall. That's not fairness. That's just how a panic works. Everything gets thrown out with the bathwater, but for the person paying attention, that's not a tragedy. That's the buying opportunity of a lifetime. Because good businesses don't stay cheap forever. The market eventually remembers what things are actually worth. It just needs time, and it needs you to not be one of the people forced to sell at the bottom. I'll tell you something else that I think about a lot, and it's a little uncomfortable to say out loud. And a lot of the financial industry actually benefits from you being confused about this stuff. The more complicated it sounds, the more you feel like you need somebody else to manage it for you. And the more fees get collected along the way, regardless of whether you actually come out ahead. I'm not saying every advisor is out to get you. Plenty of them do good work. But I am saying you shouldn't outsource your understanding completely to anybody, including me. Learn the basic mechanics of what you own. Ask boring questions like, how does this company actually make money? And what happens to it in a bad year? And you'll be ahead of the vast majority of people who just bought whatever was trending. Because a stranger on the internet told them to. I want to tell you a quick story, because I think it makes this more real than just me talking theory at you. Years back, I watched a market wobble hard. One of those days where everything was red and the headlines were screaming. And I remember a friend of mine, smart guy, good business sense, who'd been sitting on some cash for no particular reason other than he didn't love what he saw in prices. That day, while everybody else was staring at their portfolios in horror, he was on the phone buying pieces of businesses he'd wanted for years at prices he never thought he'd see again. 18 months later, those same purchases were worth multiples of what he paid. He didn't predict the exact day it would happen. He just made sure he was in a position where, when it did happen, he had options instead of panic. That's the whole game. It's not about being a fortune teller. It's about being positioned. Now, let me actually give you the disclaimer part, because I owe you that honesty. I'm not sitting here telling you to sell everything, or to go all in on any specific stock, or that I've got some secret formula that guarantees you riches. Anyone promising you guarantees in this business is either lying to you or hasn't been doing it long enough to know better. What I'm giving you is a way of thinking, a lens to look through so that when the headlines get scary, and trust me, they will, you're not making decisions out of fear. You're making them from a place of understanding what's actually happening underneath the surface. And here's another piece of this that I think people miss completely. Everyone's so focused on when the crash happens that they forget to ask what happens after. Markets have cracked before they cracked in the early 2000s. They cracked in 2008. They cracked in 2020. For a few terrifying weeks, every single time, The people who got hurt the worst weren't the ones who owned real, profitable businesses through the storm. They were the ones who owned hype, who owned stories instead of numbers, who owned whatever was popular in the group chat instead of something with an actual balance sheet behind it. And every single time, within a handful of years, the market didn't just recover. It went on to new highs. Because that's what happens when human beings build things, sell things, and solve problems for each other. The engine underneath the market, real businesses serving real customers, that part doesn't break even when the pricing mechanism above it gets shaky. So this isn't a doom video. This is a get your house in order before the storm video, because the sun does come back out. It always has. And the people who prepared calmly instead of panicking are the ones who end up in a completely different financial position on the other side. I'll be honest, I almost didn't make this video because I know how it sounds. I know somebody's going to clip this and slap market crash incoming on it with a scary red thumbnail. And that's not really what I'm trying to say. I'm not telling you the sky is falling tomorrow. I'm telling you the structure holding the sky up has gotten thinner than most people realize. And thin structures eventually get tested. That's not fear-mongering, that's just paying attention. I'd rather you hear it from me calmly with a plan than have you find out the hard way during an ugly week with no idea what to do next. So here's what I actually want you to do with this. Don't go make some dramatic move right after watching a YouTube video. That's how people lose money, not make it. Instead, take an honest look at what you actually own. Ask yourself if you understand why you own it, or if you just bought it because everyone else was buying it. Ask yourself if you got any cash on the sidelines, or if you're one bad week away from being forced to sell something at the worst possible time. Ask yourself if your portfolio is stacked into the same handful of giant, crowded names that everybody else's autopilot money is also piled into. Those are the questions that actually matter, way more than trying to guess the exact date. Something breaks if this kind of thinking is useful to you, and I hope it is. That's really the whole reason I make these videos. Do me a favor and hit subscribe, because I've got a lot more of this coming. And I don't want you missing it right when things start getting interesting. Drop a comment and tell me what you actually own right now. And I mean it. I read these because I want to know what regular people are sitting on out there, not just what the big funds are doing. And if you want to go deeper on how I personally think about protecting a portfolio in a market like this one, I put together a free breakdown that walks through it step by step, no cost, no catch, just a link down in the description. Go grab it while you're thinking about this stuff, because motivation like this fades fast once you close the app and go back to your day. One more thing before I let you go, because I think it's the most important part, and people always skip past it looking for the tactics. None of this works if you're not honest with yourself about your own behavior. I've sat across from people worth a lot of money who still made emotional decisions with their portfolio, and I've met people with a lot less who handled the downturn like an absolute pro, because they'd actually thought it through ahead of time instead of trying to figure it out in the middle of a panic. The difference was never the size of the account. It was whether they had a plan written down somewhere in plain language before things got scary, so that when the scary part showed up, they weren't inventing a strategy on the fly with their heart pounding. So maybe the real homework from this video isn't picking a stock at all. Maybe it's sitting down this weekend for 20 minutes, no phone, no distractions, and writing out 3 things: what you actually own and why, what you'd do if it dropped 30% tomorrow, and what price, if any, would make you excited to buy more instead of scared to hold on. Do that, and you'll be ahead of 90% of people out there who only ever think about their portfolio when it's already too late to think clearly. Look, I've made a lot of money in my life, and I've lost a lot of money too, sometimes in ways that still make me wince thinking about them. If there's one thing all those years taught me, it's that the people who do well aren't the smartest people in the room, and they're usually not the loudest either. They're the ones who stay calm, who understand what they own, who keep a little dry powder ready. and who don't get shaken out right before the good part happens. That's really all I'm trying to hand you today. Not a prediction, not a guarantee, just a heads up and a plan, so that whenever this thin ice finally does crack, and I do think it will, you're one of the people reaching for opportunity instead of one of the people reaching for the panic button. Take care of yourself, take care of your money, and I'll see you in the next one.